Good morning, good afternoon, and good evening, folks. If you guys can hear me well, and if you can also see my screen, please give me a sound check and screen check by saying yes or no. Okay, thank you so much for everyone who has replied. Greatly appreciate that. Right, okay, so the topic for today is obviously the masterclass is focused on how to trade indices. So I'll be answering some really important questions, looking at the fundamentals and of course the technicals behind them, such as, has the market formed a bottom? Is the US market heading towards a recession? Sorry about that, I don't know what that. Right, apologies for that little bit of a disturbance coming from the next door. So those are the sort of questions that we'll be really very much focused on in today's webinar. A bit about myself. My name is Naeem Azam. I work as a chief analyst for AvaTrade. My wealth of experience spans well over 15 years of trading experience. During this time period, I worked as a hedge fund trader for Bank of New York Mellon, as an equity trader with Bank of America. Many of you may have seen me as a regular guest on CNBC, Bloomberg, and several other media channels. Here are the social media handles for AvaTrade. I do recommend you guys to follow us there as we share important information throughout the day. And of course, the recording of this one will be also available on our YouTube channel. Now, something that I wanted to share with you is our unique technology called AvaProtect. AvaProtect is a revolutionary one-click risk management tool available on the AvaTrade Web Trader and AvaTrade Go app. With AvaProtect, you can purchase protection against loss for a defined period after opening a position. If the protection ends and you have an open position that is losing, AvaTrade will reimburse the loss directly into the trading accounts. The only cost is the AvaProtect fee itself. Now, let's get to the main thing, and that is, here are some of the study questions, and many of you would have attended my webinar already, and so you would know some of the basics of these ones. So for those of you who have attended these webinars before, so this is time for you guys to shine and answer some of the study questions which we are about to ask. So we're going to start with the first one, and that is why to trade indices. Why do you guys think indices are quite important? Feel free to give us any answer that you think is more plausible or you think is more reasonable. So why one should trade indices? In fact, the first basic question for many of you would be that what are indices? Could you give me an example of some of the indices, some of the stock indices we are really referring to? So yeah, the answers are correct. So the answers are so some of the answers are saying that okay, you trade indices to hedge your risk. You trade indices because when you have small capital and you wanted to have a wider exposure. What we mean by that over there is that let's say you have $1,000 in your account. With the $1,000, you can only trade so many stocks. Like you will run out of your account very, very soon. So what would you do if you wanted to buy Apple, you wanted to buy Amazon, you wanted to buy Netflix, you wanted to buy Microsoft, you wanted to buy AMD, Intel, and the list kind of continues, right? So what would you really do with $1,000? Obviously, you can't buy much. And then these are only handful stocks that we have really referred so far. So if you wanted to have an exposure to all the tech stocks, the best thing to do under those circumstances would be to buy the US Tech 100, which is known as, or widely known as, the US NASDAQ 100 index, right? The US NASDAQ. So that when you buy that particular index, you have an exposure across all the 100 tech stocks, right? So by just buying one stock index, so you get an exposure against across all the 100 stocks. In addition to that, you don't have your risk, all your eggs in one basket. Now, your risk is very much hedged against number of stocks. So if you buy US Tech 100 Index or the US Nasdaq Index, your risk is primarily spread across 100 different stocks. Does that does that make sense to you guys? Are you guys following me? So these are some of the most important reasons that you would trade. And here is another very great example why one wants to trade index. For day traders, the instrument which is highly favorable among them is called what they use the most is, of course, a stock indices as well. So because a normal stock wouldn't really move that much, you wouldn't have that much of a volatility. With the stock indices, you have that extra room, because in case of Dow Jones Industrial Average, the average move is between 300 to 500 points a day very easily. So if you're a day trader, that's like, depending on how many points or or what's the position size, you could see that there is enough meat on the bone really there for you guys to really look at. So if you're looking at for stock, stock is only like a couple of pence to $1, depending on which particular stock that you're really looking at. So for day traders, they really sort of prefer trading indices. So what are the top 3 US stock indices? Firstly, it is the S&P 500 index. The S&P 500 index gives you exposure across all the 500 top stocks in the United States. Just like how the Nasdaq 100 gives you exposure across all the 100 tech stocks in the United States, S&P 500 gives you exposure across all the 500 top companies. Now, the third stock index, which is quite famous among investors and traders, and I've mentioned before just now, is the Dow Jones Industrial Average. With the Dow Jones Industrial Average, you have top 30 industrial stocks, in top 30 industrial stocks, which form one index called the Dow Jones Industrial Average. And again, the average move is between 300 to 500 points. Now, for day traders, and many of you would be part of that in this particular session, if anyone has a question, please don't raise hand. Just pop the question straight away. You don't need to raise hands. Just ask the question straight away. What is VIX index over here? Can anyone answer that particular question? What is VIX index? Correct, right on the money. VIX index stands for volatility index. This tells us that how much uncertainty is really in the market. If traders are feeling comfortable with the risk that they are taking currently in the market, or if traders are not feeling comfortable with the risk that they have in the market. So these are sort of important points that we need to pay attention to. The relationship is the most important thing between the VIX index and the stock index. So let me explain what I mean by that. Where the question is coming, where can I trade these indices on the AvaTrade app? Great question, Miguel. I will show you that when we come to defining levels. We're going to go the AvaTrade app and then we're going to show you that. Just bear with me, but great question. There's no question which is wrong. Always be encouraged to answer as many ask as many questions as you can. So again, we have US 500 index over here, which is your S&P 500 index, and on the other side we have your volatility index. Now, what is the relationship? Now, this one over here, usually this moves to the upside when there is a lot of uncertainty in the market. This one over here here moves to the downside when there is a lot of uncertainty in the market. This one, S&P 500 index, moves to the upside when investors are feeling comfortable with the riskier trades. They feel happier about the sentiment, so this one moves to the upside. What happens here with the volatility index? It naturally moves to the downside. So you could see the relationship between the volatility index and the S&P 500 index is really opposite. When this moves down, this moves up. When this moves up, this moves down. That is the relationship between the VIX index and the S&P 500 index. Tells us again how much uncertainty is in the market. If traders are really concerned about the market, if they do not believe that what is happening in the market right now or not. So all that uncertainty is very much represented in terms of the volatility index. So what is the volatility index really telling us now? Is it to the so again the answer to that question will be coming in a second when we or in few minutes when we will go and we will look at that. Now the next important question after looking at the first two questions is a recession heading for the US? Because this particular word has gained a lot of attraction in the markets recently. What is a recession? Recession, the definition of the recession has been changed by the US government more recently, but usually when the GDP falls for the 2 quarters consecutively, we officially enter into a recession. But now the definition has become more complex. It means the unemployment is also got to be down, the consumer spending got to be down, consumer confidence got to be down. So they've changed the definition of a recession now. So they've just changed the goalpost in relation to that. Is the US economy really in recession currently? While the GDP growth, meaning the growth of the country, isn't really there. Consumer confidence isn't really there as well. It is weakening. So overall, the economic data is painting a very, very bearish picture. What do we mean by the bearish picture? Meaning it's a weak outlook for the economy. What have we learned from earnings so far? Because we are in an earnings season now. So the earnings season has told us 2 important messages. Can anyone guess what are the 2 important messages that the earnings season has given us so far? I'm going to write one of them right over here. The first one is, of course, the unemployment market, because employment freeze or firing people, letting go of the people, of the employees, has been the dominant theme so far in the market. And the other one is cautiousness in terms of the spending. So companies are really cutting down on spending. They are being more careful how they spend or invest their capital in the market. So they are really careful with that respect. So what do these 2 elements really tell us overall? What do these 2 elements tell us is that we are very much heading right towards this particular situation. And if we are not already there, that means a recession, slow economic activity, or slower growth. So these are the most important messages that we have received so far from the US market, right? Any questions on that so far? Because it's important for you guys to understand these concepts. Once again, I wanted to emphasize on this particular thing that please do not hesitate to ask questions, because there's no such thing which is called a wrong question or right question. Now, let's move on to the next important question. And the next important question is, has the market, by markets we mean the US stock market, the S&P 500 index, the Dow Jones Industrial Average, or the S&P 500 formed a bottom. What do we mean by a bottom? Can someone really define what I mean by the word bottom? absolutely correct. The bottom means when the market kind of falls and falls and falls and falls and falls, and then it gets to a point where it doesn't fall anymore. Either it moves to the sideway, or either it begins to move to the upside. This particular area is very, very critical, or the lowest point, as Amrithan has mentioned. Norman has said double bottom. That is absolutely okay as well. But I will explain to you, double bottom is when the market falls, it comes over here, it goes a little bit up, and then come back to the same particular point, and then goes back up. So we have one bottom formed over here, and then we have another bottom formed over here. That is called a double bottom. Now over here is, we are talking about a normal bottom, and that means has the market reached the lowest point, that beyond this particular point the market is not willing to fall any further. Bulls have stepped into the market and they're pushing the markets to the upside. This particular element, this particular thing is what we call if the market has formed a bottom. Now if the market has formed a bottom, if the market hasn't formed a bottom, we will look at that from the market's perspective. Just in a bit, we're going to go on to the charts, and then we're going to look at these two important ones, defining levels and defining strategies. But are you guys clear about this particular concept so far?
Try again. Yeah, I know. Thank you. Are there any other answers? Okay, this actually
So someone has asked me a very, very important question, and that question is that, can you tell us what as the consumer confidence is really telling us about the markets? So the consumer confidence, the data which came out yesterday, is still very much pointing to one particular factor. And that particular factor is that, US consumers are not spending, because look at what Walmart did. Look what a Target did. These are big US consumer staple companies. So they are telling us they do not see that. Even McDonald's yesterday said they're selling less meals because consumers are not spending. So consumer confidence data, which came out yesterday, isn't really the actual reflection. The actual reflection comes from the companies like Walmart, like McDonald's, like Target, like Amazon, and they give us a lot more better idea. Now, the question was asked, where do we find the companies, the indices on AvaTrade go up? So here it is, the first one, which is called the US 500 index, or the S&P 500 index. So all what you do is you AvaTrade with app, and then you type over here, and then now we have it here. What we're looking at in terms of this particular one is we are on the weekly time frame. This was the area which we talked about previously as an area of support, and someone also talked about a double bottom. So this was a sort of a bottom, because first bottom was over here, the other bottom was formed right over here, so we have a double bottom. But usually speaking, double bottom is formed much more closer. This is just coming to the same sort of as so support point, and market is really sort of moving from that particular point. So it's not really a double bottom, your traditional double bottom that you will see in the market. So I want you guys to be very, very clear about that. So what we really see in terms of the market right now is that, yes, this was the point where the bottom was sort of formed in terms of the market. And from here onwards, what we really see from the market's perspective really is the market is just not willing to go down from this particular price point. So remember what we were talking about earlier, that the market is dropping, going up, dropping, going up, dropping. But from here, the market kind of formed something, and then that after that it decided that it can no longer fall further from this particular price point. Hence, what we've seen is really a price level which has started to push the markets higher from this particular price point. So that is the important thing that we need to pay attention to. Now the big question really is, will the market will continue to move higher from here onwards? Now, what we're going to do is we're going to go into a slightly smaller time frame, which is your daily time frame, which is right over here. So what we're going to see is that, look, this is our resistance zone right over here, which runs from 4,143 to 4,193. The market is trading at 3,959. This was our support zone near 3,646. So we are right in the middle. This line over here is very much indicating to us that this was a very recent resistance, right, which the market was looking at in terms of the price action. In addition to that, we have formed a this, and we have formed a ascending triangle. So if this one can work for me, just a thing is, so just trying to get this one. Okay. So what we see is this is an ascending sort of a triangle, right? So what this is telling us is the bullish pattern has already sort of formed over here. The price has broken out of this bullish pattern, and the prices are looking a lot more bullish when we look at the S&P 500 index daily chart, because what this is telling us, the prices are more likely to follow an upward trend. But the question really is, can you trade this one? Well, if you wanted to trade this particular price point right now where it is, what we got to do is we got to find a price level which kind of explains our stop loss. So I would say the low of this particular candle gives us a good stop loss level. So if you are looking to trade this particular index, what we really see is that 3,922 as an important support level, and this is going to be your resistance. So your risk is going to be only this much, between 3,957 to 3,922, running all the way to 4,143 to all the way to 4,193. These are the sort of support levels that we'll be very much looking at in terms of the price levels. So the risk to reward ratio is certainly there for us, so to really look at that trade. Now again, I'm gonna recap what we really discussed over here. So what we have discussed so far is that this is your S&P 500 index. You put as a US 500 index over here. It is in a downward trend. This area marked the bottom in the price action. This over here is your ascending triangle. Prices failed to break anything lower than this one. The prices are breaking to the upside. It looks like that the price has formed a bottom for now, and the risk to reward ratio that we wanted to look at is we want to put our stop losses just below the 3,922. We wanted to target this area as a resistance, because if the price falls below this stop level, the low of this particular candle, then that means the prices are going to be moving further to the downside and then coming back, retest this one. And that will form the double bottom that we discussed earlier. or the price can actually continue to fall further from this one, and then we could see more weakness coming into the market. At that time, it will say that, okay, this was nothing but just a dead cat bounce, and the market is going to be moving from here to its next important support level, which is going to be 2,949 to 3,112. Now, what about the US 30 or the US Dow Jones Industrial Average, right? So when we look at the weekly chart on this one, we see similar sort of a price action. We see this area as an area of support, which runs from 29,237 to 29,777. This is of an area of resistance, 34,043 to 33,059. Let me just see quickly if there are any questions, because I see a lot of hands over here. Last night, just a few minutes after the market closed, there was a high volatility on the US Tech 100 index and a sudden rebound up. Can you please explain that, what happened? Okay, I will look at that as well. I'm seeing. All right. If anyone has any questions, please continue to send those questions, and I'm keeping an eye on them. Right. Okay. So now this is exactly the same situation as the other particular index that we looked at, which is your S&P 500 index. Now we're looking at the US 30 index. So again, we have this ascending triangle. So your stop loss under the current circumstances is going to be, so I'm going to form this particular one over here. So your stop loss is really going to be right at the bottom of here. So this is going to be your stop loss right over here, okay? So that is your stop loss. So your risk is from here to here, but your reward is over here. So not that much of a great risk to reward ratio, but we have to keep this bit of a room for maneuverability because this is Dow Jones Industrial Average. So if you wanted to mark that price level on the chart, I'm going to mark it right over here to the bottom of this one. So 30,987, currently trading at 31,882. So that is your stop loss, and your target is going to be 33,559. It has formed that ascending triangle. If you draw from one line to here, the other line over here, you will see that the ascending triangle has formed. But if it breaks below this particular low, then we are heading back over here. The original price level, the original resistance support level that we've talked about. So that means either the price is going to form a double bottom, or the price is going to be moving further to the downside, coming into this area of support. Now, the last one that we're going to touch in terms of the price action is the US Tech 100 Index, US Tech. So which is your NASDAQ. So again, on the weekly time frame, what we're really looking at is we're going to get rid of this particular trend line, and we're going to get rid of this particular trend line. So we're going to be focusing on this support level, which is 10,642 to 11,118. So this is the point. This was your risk support area, which supported the market and then pushed the markets a little bit higher. As you can see that the prices are moving to the upside. Again, the same sort of a pattern is very much formed over here, which is your ascending triangle on the daily time frame. So if I make that one like here, so again, if you don't know how to draw that ascending triangle, just over here, put your line over here, one line over here. Again, we're going to use the same one line over here, the other line we're going to draw it over here. So you have that okay, so there we go. So you have your ascending triangle forming over here. So this one is showing already quite a lot of weakness into the price action, because over here the price, the US Tech 100 Index has actually failed to break to the upside like the US 500 or US 30. So this really isn't really showing much strength, but if you still wanted to trade this particular one, then really the nearest support zone is going to be the lows of these particular candles, or in other words 11,845, and you will still target this as an area of resistance. So all in all, guys, it is important to mention that that the markets have, so to answer this particular question, that if the markets have formed a bottom, well, markets are in a process of forming a bottom. The US Tech 100 index seems like that it hasn't, and then it has more risk to the downside. For the Dow Jones Industrial Average and for the S&P 500 index, there are some proofs that market is moving to the upside. We have defined the levels and everything in relation to that. The recording of this particular webinar is going to be available on our YouTube channel. So feel free to head there and then watch that. And I will see you guys same place, same time next week. Until then, stay safe.